Did you know that some Australian homeowners have lost over $150,000 in just the past 12 months? In cities once considered safe bets for property investment, prices are now tumbling fast. From coastal havens to capital city suburbs, cracks are showing. And for some, the dream of home ownership is turning into a financial nightmare. So what's really going on? Why are once booming housing markets suddenly crashing? Is it rising interest rates, falling demand, overdevelopment, or something deeper and more dangerous? The truth is, there's a quiet storm sweeping across Australia's real estate landscape, and most people don't see it coming until it's too late. But if you're a homeowner, renter, or thinking about buying, this is a trend you can't afford to ignore. In this video, we're breaking down 10 Australian cities where the housing market is falling fast, with real numbers, expert insights, and warnings you won't hear in the headlines. Let's dive in. Number 1. Sydney. For years, Sydney was the crown jewel of Australia's property market. Prices soared to record highs, driven by international investors, tight supply, and the belief that property always goes up. But now, that narrative is crumbling, fast. In the past 12 months alone, parts of Western Sydney and the inner west have seen housing prices drop by more than 10%. In suburbs like Parramatta, Blacktown, and Ryde, sellers are slashing prices just to stay competitive. And it's not just a small correction, it's a sign of something bigger. According to CoreLogic data, Sydney's median house price has fallen by over $100,000 in some pockets, wiping out years of growth in a matter of months. So, what's behind the crash? It's a perfect storm. Rising interest rates have made mortgages unaffordable for many, especially those who bought during the boom. Meanwhile, cost of living pressures and stagnant wages are forcing potential buyers to pull back. Add in an oversupply of newly built apartments, especially in outer suburbs, and you've got a market that's now tipping toward free fall. But here's the kicker. Many homeowners are now in negative equity, meaning their property is worth less than their mortgage. And with borrowing power shrinking, demand isn't likely to bounce back anytime soon. For Sydney, the days of unstoppable growth may be over, at least for now. So if Sydney, once the country's safest bet, is falling, what's happening in the rest of Australia? Number 2. Melbourne. Melbourne was once the poster child of rapid growth and urban sprawl. During the pandemic, it saw a huge surge in buyer activity, especially in the outer suburbs where new estates popped up overnight. But now, the very suburbs that were booming are becoming the epicenter of the crash. Take areas like Cranbourne, Truganina, and Melton, once affordable hotspots for first home buyers. In just over a year, some of these suburbs have recorded price drops of up to 12%, according to data from Domain and CoreLogic. It's a massive blow to buyers who stretched their budgets during the frenzy, only to find themselves with homes now worth less than what they paid. So, what's causing the meltdown? A few big reasons. First, Melbourne's outer ring suburbs were heavily fueled by cheap borrowing and government incentives, like HomeBuilder. But when rates rose, those low deposit loans turned into financial traps. Many buyers are now struggling with rising repayments and falling equity. On top of that, there's an oversupply of new developments and not enough demand to absorb it. The city's once strong population growth has also slowed, with interstate migration and lower overseas student numbers impacting demand. Rental yields are weak in many of these areas, making them less attractive for investors. Melbourne's property market isn't collapsing everywhere, but in certain suburbs, the damage is real and growing. If you bought during the peak and plan to flip or upgrade soon, you might want to rethink your timeline. And Melbourne's not alone. Let's head south to a city that went from the hottest market in the country to a cold reality check. Number 3. Hobart. Just a few years ago, Hobart was the fastest growing property market in Australia. Home values surged by over 60% between 2017 and 2021, driven by a wave of interstate investors, tree changers, and Airbnb opportunists. But what goes up fast often comes down even faster. Now, Hobart is leading the nation in property price declines. According to recent CoreLogic data, the median house price in Hobart has dropped by nearly 13% year on year, the biggest fall of any capital city. The once red-hot suburbs of Sandy Bay, Kingston, and West Hobart are now seeing fewer buyers, longer listing times, and price cuts that would have been unthinkable just 2 years ago. So, what triggered Hobart's dramatic turn? A big part of it is the affordability ceiling. Prices rose so high, so quickly, that locals were priced out, and demand naturally slowed. Then came interest rate hikes, which hit lower-income buyers and small investors especially hard. On top of that, tourism slowed, and with it, the short-stay rental market that had propped up investor demand. Vacancy rates are now rising, and rental returns are falling. Many investors who banked on Airbnb profits are offloading properties, adding to the supply glut. And for first-home buyers who entered during the peak, they're now watching their equity vanish. Hobart's boom was impressive, but its bust might be even more telling. It's a warning for smaller cities riding the same wave. Next, let's head to the nation's capital, where policy cuts and softening demand are shaking up the market. Number 4. Canberra. Canberra has always been seen as a stable and steady performer in the Australian housing market. Backed by a large public sector workforce and consistent rental demand, it was considered a safe place to buy. But in 2024 and 2025, even the capital isn't immune to the downturn. In the past year, property prices in Canberra have fallen by around 9%, with inner-city suburbs like Braddon, Turner, and Gungahlin seeing some of the sharpest drops. Auction clearance rates are sliding, listings are staying on the market longer, and open homes that were once packed are now eerily quiet. So what's changed? A combination of factors. Rising interest rates have reduced buyer borrowing power, just like in the rest of the country. But Canberra is also being hit by federal job cuts and hiring freezes, weakening the city's employment confidence and suppressing demand. Fewer new public service contracts mean fewer relocations, and that's bad news for the local rental and housing markets. Meanwhile, rental yields are slipping and vacancy rates are creeping up. Investors are starting to leave, and tenants have more choices. Even apartments, which once seemed like a solid investment here, are now struggling to hold their value. The shine is fading from the capital. While Canberra may not crash as hard as some regional areas, it's a clear example that no market is truly bulletproof. Coming up next, let's take a look at a city once seen as a booming alternative to Melbourne, and how its luck has quickly turned. Number 5. Geelong. Just a few years ago, Geelong was the golden child of regional property growth. As Melbourne's house prices soared, buyers looked to this coastal city for affordability, lifestyle, and easy commuting options. During the pandemic, demand exploded, and so did prices. But now, the boom is over, and the crash has begun. Property values in Geelong have dropped by up to 10% in key suburbs like Armstrong Creek, Lara, and Corio. These were the areas that saw rapid development, fast investor interest, and a flood of first-home buyers. But in 2025, they're now seeing diminishing demand, rising listings, and stagnant buyer interest. So, what went wrong? For one, remote work is reversing. Many people are now returning to Melbourne offices part-time, weakening the appeal of the regional escape. Interest rate hikes have also made once affordable mortgages suddenly unaffordable. And with more supply than demand, developers are cutting prices, triggering a race to the bottom. The rental market isn't helping either. Short-term investors who banked on strong yields are seeing returns shrink. Many are offloading their properties, increasing supply, and putting downward pressure on prices. Geelong's growth story was built on momentum and emotion, but now Logic and numbers are taking over, and the numbers don't lie. If this is happening in Victoria's second largest city, it's a clear red flag for similar markets across the country. We pour hours of research and editing into these videos, so if you learned something new, show some love and click that subscribe button. And tell us in the comments, is your city showing signs of a crash? We read every one. Number 6. Ballarat. During the pandemic, Ballarat became a surprise success story. As people fled Melbourne in search of space, affordability, and a quieter lifestyle, Ballarat's housing market exploded. Prices rose by nearly 30% in some areas between 2020 and 2022. But now, the tables have turned, and the signs of a crash are becoming harder to ignore. Recent data shows that property prices in Ballarat have dropped by 8 to 10% across several key suburbs, including Alfredton, Delacombe, and Sebastopol. Properties are sitting on the market for weeks longer than before, and buyer interest has cooled significantly. What was once a seller's market is now struggling to attract serious offers. So, what caused the shift? First, the COVID-driven migration boom has ended. Many city dwellers who moved to Ballarat for remote work are now being called back to offices, or are reconsidering their decision entirely. At the same time, rising interest rates are hitting hard in regional areas, especially where buyers stretch their finances to get into the market. There's also been a surge in housing supply, with developers racing to build during the boom years. Now, many of those new homes are sitting empty or being listed at discounted prices, creating downward pressure across the board. Ballarat's crash isn't as dramatic as Sydney's or Melbourne's, but it's a clear example of how regional markets aren't immune. When a market grows too fast, it often sets itself up for a hard landing. Next, we're heading to a coastal city that once thrived on lifestyle demand, but is now watching buyers disappear. Number 7. Wollongong. Wollongong was once the go-to escape for Sydney buyers looking for ocean views, relaxed living, and more affordable prices. During the pandemic, demand soared as remote workers and investors flooded the market. Prices jumped by over 35% in just 2 years, especially in popular areas like Thirroul, Woonona, and Fig Tree. But that wave has crashed, and fast. In the last year, property prices in Wollongong have dropped by 9 to 11%, with some high-end homes slashed by hundreds of thousands. Buyers are now far more cautious, and sellers who were expecting bidding wars are facing lowball offers and long wait times. It's a stark contrast from the frenzy of 2021. So, why the sudden shift? Rising interest rates have made borrowing harder for the typical Wollongong buyer, many of whom already stretched their budgets during the boom. On top of that, the lifestyle migration trend is fading. As people return to office life and city amenities, the appeal of living further out has cooled dramatically. There's also growing concern about oversupply, particularly in new apartment developments closer to the CBD and uni precincts. Investors are backing out, short-term rental profits are shrinking, and vacancy rates are starting to climb. What was once a market fueled by fear of missing out is now dominated by fear of overpaying. Wollongong's market may still look pretty on the surface, but underneath, the cracks are widening. And it's a cautionary tale for anyone chasing lifestyle over fundamentals. Next up, a city that saw a flood of investors during the tourism boom, now facing a sharp correction. Number 8. Gold Coast. The Gold Coast has always been a magnet for investors, retirees, and lifestyle seekers. And during the pandemic, its property market exploded. With borders closed and overseas travel restricted, domestic tourism boomed, and so did property demand. High-rise apartments, beachfront homes, and holiday rentals flew off the market. But fast forward to 2025, and the glitter is starting to fade. According to PropTrack and CoreLogic, house prices on the Gold Coast have dropped by 8 to 12%, with suburbs like Surfers Paradise, Southport, and Robina among the hardest hit. The market is now saturated, especially with Airbnb-style properties that no longer generate the returns owners once hoped for. Many of these are now flooding the market, pushing prices down further. So, what went wrong? For starters, the tourism-driven investor boom has backfired. As international travel resumed and domestic tourism normalized, short-stay demand dipped. Meanwhile, rising interest rates and tighter lending criteria have priced out many first-home buyers and even some seasoned investors. Another big issue is oversupply, particularly in the apartment sector. Dozens of high-rise developments launched during the boom are now hitting the market at a time when demand is cooling. Add to that rising maintenance and body corporate fees, and many investors are walking away from what used to be dream properties. The Gold Coast still has the views and beaches, but the property market isn't riding high like it used to. And with more stock coming online, prices may not recover quickly. Next, we head further north to another lifestyle hotspot, now grappling with a sharp reversal in buyer confidence. Number 9. Sunshine Coast. The Sunshine Coast was once hailed as a post-pandemic property success story. With stunning beaches, relaxed living, and a flood of remote workers and retirees escaping the cities, demand skyrocketed. Between 2020 and 2022, house prices surged by over 40%, making it one of the fastest growing markets in the country. But now, the cracks are showing, and fast. In 2025, the Sunshine Coast is seeing price drops of 10 to 13% in suburbs like Maroochydore, Caloundra, and Buderim. Homes that once had lines of eager buyers are now sitting on the market for months. Even new developments and coastal luxury homes are facing price cuts and falling interest. Why the dramatic reversal? Much like the Gold Coast, the Sunshine Coast relied heavily on the lifestyle migration boom. But as remote work becomes less common and more people return to city offices, demand has softened significantly. Interest rate hikes have also hit hard, reducing borrowing power for locals and interstate buyers alike. There's also been a massive uptick in new builds, many of which were planned during the height of demand. Now, with fewer buyers and more supply, sellers are being forced to drop their prices. Investors are also stepping back as rental yields flatten and tourism-driven income slows. The Sunshine Coast still offers natural beauty and appeal, but its housing market is no longer riding high. For those who bought at the top, it's become a lesson in what happens when hype overtakes fundamentals. Finally, let's head to the top end, where a quiet crash is unfolding in Australia's smallest capital city. Number 10. Darwin. Darwin has always been a bit of an outlier in the Australian property market. Smaller, more remote, and deeply tied to government, defence, and mining jobs. It tends to move to its own rhythm. But right now, Darwin is quietly experiencing one of the most prolonged and painful downturns in the country. According to CoreLogic, Darwin's house prices have fallen by around 8% in the past year. But the real story goes back much further. Since peaking nearly a decade ago, Darwin's market has struggled to regain momentum. Unlike other capitals, it didn't enjoy the same post-COVID boom. And now, with rising interest rates and sluggish population growth, it's slipping even further behind. One major issue is stagnant demand. With fewer people moving to the Northern Territory and many locals leaving for better job prospects elsewhere, the market is suffering from low buyer activity and growing rental vacancies. Rents are falling in some suburbs, and investors are beginning to exit the market, fearing long-term stagnation. At the same time, Darwin faces unique challenges: harsh climate, high insurance costs, and limited economic diversity, all of which deter large-scale investment and long-term growth. Even local developers are pulling back, citing risk and uncertainty. Darwin's housing downturn isn't dramatic like Sydney's or sudden like Hobart's, but it's slow, steady, and deeply rooted. And for many homeowners, that's even more worrying, because a slow crash can take years to recover from. As we've seen across these 10 cities, the Australian housing market isn't just cooling, it's cracking, and in some areas, it's collapsing. What was once considered a sure thing has now become a high-stakes gamble, with interest rates, oversupply, and changing migration patterns turning once booming suburbs into high-risk zones. But here's the thing, this isn't about fear, it's about awareness. Property isn't just bricks and mortar, it's tied to people's lives, savings, and futures. Whether you're a homeowner, an investor, or someone hoping to break into the market, understanding where these drops are happening and why can help you make smarter, safer decisions. Real estate always moves in cycles. Some of these cities may recover faster than others, while some could continue sliding for years. The key is to look beyond the headlines and truly understand the local forces driving the market. So before you buy, sell, or invest, ask the hard questions. Because in a market like this, what you don't know can cost you thousands.